Hello, everyone, and welcome back to the channel. I'm Megan Madison, your dedicated Texas mortgage loan officer with Castle Hills Mortgage. And today we're diving into a topic that's absolutely essential for anyone dreaming of homeownership: becoming a creditworthy borrower for a mortgage. Getting approved for a mortgage might seem overwhelming, but with the right knowledge and a clear strategy, it's absolutely achievable. In this video, we'll cover what lenders look for, specific ways to boost your credit score, how to protect your credit during an income shortfall, and how to recover if your credit has taken a hit. Let's get started. When you're ready to apply for a mortgage, lenders are essentially asking one big question: can you handle a large loan responsibly every month and for the long haul? Your credit report gives us that answer. The magic number everyone talks about is your FICO score. For most conventional loans, we want to see 620 or higher. But to qualify for the best rates and terms, aim for 740 or above. Quite honestly, if you're below a 700 score, I'm likely going to believe that an FHA loan is more suitable due to rate and mortgage insurance factors. Once I have a full picture of your profile, I can recommend which direction to head in. Here's a general breakdown of credit scores. Generally speaking, between 850 to 800 is the best rates and the easiest approval odds. 799 to 740 are great rates and strong approval odds. 739 to 670 is going to get you your standard rates with a solid approval. And then your fair credit scores are between 669 and 580. You're going to have higher rate and the FHA loan option becomes more relevant. Anything below 580 is considered poor. It's a difficult approval and I would recommend improvement before securing a loan. But of course, that would be depending on your circumstance. The next thing we consider is your debt to income ratio, or DTI. It compares what you owe each month to what you earn. We look at two main types. Front-end ratio, which is your housing costs only, should be between 28 and 31%. Your back-end ratio, which is housing and all other debts, should ideally be below 36%, though some programs allow between 43 and 50%. Some other key factors that we're going to consider is the length of your credit history, your consistency of on-time payments, a healthy mix of credit account types, and low credit utilization. Ideally, under 30%, your best scores are reflected at or below 20%. What does that mean? Well, if you have a credit card with a $1,000 credit limit, 20% of that is $200. You want to close your monthly statement at or below $200 balance. That wording is so important, so let me say it again. If you have a credit card with a $1,000 credit limit, 20% of that is $200. You want to close your monthly statement at or below $200 balance. When you're done with this video, check out my video on managing credit debt. The link is in the caption below. Now let's get practical. Here are real actionable steps to raise your scores. The first thing is pay your bills on time every time. This makes up about 35% of your score. Set up auto pay if you feel comfortable and set reminders in your phone. Look at your monthly bills and schedule out their statement close dates as well as the regular due dates in your paper or phone planner. Plan your payments around your paychecks. Review them on the 15th of the month prior, meaning on January 15th, take some time to sync up your income payments with each bill that's due. That way, you have time to move things around or reach out to creditors if you realize you may run into a problem. Communication is key and can help avoid a lot of headache and heartache when it comes to credit. Even one late payment can cost you dozens of points on your score and a lot of money when trying to capitalize on using credit. Handle your payments with care. Number 2, lower your credit utilization. Keep balances under 30% of your credit limit. Ideally, under 10%. Anywhere in between is pretty good. No one wants to be in consistent debt, so try to pay your balances down as quickly and as much as possible. Alternatively, you can request a limit increase, and I only recommend this if you think you can responsibly manage that. Number 3, keep old accounts open. Older accounts strengthen your credit history. That's about 15% of your score. Unless there's a fee or an issue, don't close them. Number 4, limit new credit applications. Every hard inquiry, slightly drop your score. Avoid applying for new credit 6 to 12 months before your new mortgage application. And number 5, check credit reports regularly. Go to annualcreditreport.com for free copies of all 3 bureaus. Dispute any errors because they can unfairly drag drag your score down. In fact, I would encourage you to sign up for free credit monitoring services. Something like Credit Karma will alert you when your credit is pulled or when a new account opens, and even when a payment that you may have forgotten about reports as late. This can help you prevent fraudulent accounts from wreaking havoc on your credit, and it can help you attend to missed payments as soon as possible. The sooner the better when it comes to managing this type of credit issue. Protecting your credit during credit shortfalls is important. Life happens, job loss, reduced hours, unexpected expenses. Here's how to protect your credit when times get tough. Number 1, contact your creditors immediately. Don't wait until you miss a payment. Explain your situation. Many offer hardship or deferment programs. This works wonders for relieving stress during challenging financial times. You would be surprised how they're willing to work with you sometimes. Be aware, having a history of on-time payments with them will increase the odds that they'll be willing to work with you during a financial crisis. So staying on top of your payments is essential. Number 2, prioritize payments. Pay secured debts first. Your mortgage loan, your car note, etc. Then tackle high balance credit cards to manage the utilization. You may even want to consider a small debt consolidation loan from a credit union or something like that to eliminate credit debt and convert it to installment debt. That's a tidy little bow to wrap it in. If needed, negotiate extensions for utilities and smaller bills that aren't as credit impacting as others. Don't be afraid to make calls when things come up. Use your emergency fund is number 3. If you have one, this is exactly what it's for. Aim to build 3 to 6 months of living expenses before a crisis hits. I cannot explain the importance of this enough. I often hear family and friends discuss what or how they deserve to spend their money. Have you or a loved one used this reasoning to justify spending money that you should really be saving? I have been working hard all this time. I deserve XYZ luxury vehicle. If I don't treat myself, who will? If not now, when am I going to get the chance to do this again? Here's another one. Scared money don't make no money for betting or gambling. And then also, you can't save your way to being a millionaire. That's all well and fine. These are all things that we think and we feel, and it's perfectly fine to act on after you have the security of a financial safety net. Not using your 401k, not using your potential inheritance from Mima's house, and certainly not leaning on friends or family to help with your necessities after you've gone out to have fun with your own money. Calculate your true monthly obligations by looking at your last 3 months' bank statements. Add up your need to pay monies and then add up your fun money. Save 6 months of need to pay and 3 months of want to play. And then forget about it. Don't even look at the account. If it's not to be used as a piggy bank at all, leave it alone. Additionally, a lot of jobs will allow depositing a portion of your income into different accounts. See if you can manage depositing $50 into a hard-to-access account. That can help create discipline around saving and managing your money. Number 4, avoid high-interest payday loans. My goodness, they often make things worse. Instead, explore consolidation loans, reputable credit counseling. Anything over 15% for installment and 25% credit cards is considered high. Avoid payday loans at all costs. It's a trap. Trust me. I understand times can be hard. Explore every other option beyond a payday loan. Notice how they only put those type of places and those companies in less than affluent neighborhoods. Why? Because it's predatory, and only those desperate for immediate financial relief would entertain the terms that come with a payday loan. The best way to avoid this is to have a plan in place. Don't let your ego allow you to make decisions that will hurt your finances for months and even years down the road. If your credit has taken a hit, don't panic. It's fixable with time and strategy. Our step 1 here is get a clear picture. Get your credit reports from all 3 bureaus. Find out what's hurting your score, whether it be late payments, collections, or charge-offs. The more late payments you have, the harder it'll be to recover. After a certain number of collection accounts regarding a mortgage pre-approval, even if your score is within qualifying range, those accounts will prevent an automated approval for your file. A manual underwriting process creates headaches. It's doable, but you don't want to have to. While we're here, let's discuss auto loan, repossessions, and rental collections and eviction. Remember I said earlier, the one big question we ask as lenders is, can you handle the responsibility of a large loan for the long haul? A repossession says that something happened that prevented you from properly managing a previous smaller loan, and the people who extended the loan to you took their collateral back. When you sign a contract to buy a car, you're promising, giving your word, that you will make equal monthly payments for the term to reimburse the lender for giving that money to buy the car. I often hear clients tell me they brought the car back or they, quote, let it go. I want to encourage you to be honest with yourselves. Sometimes payments become too much to handle. The stress becomes too much and you go back on your word. You make that choice. I want you to know there are other choices that can be made when you're able to plan. If you do not have negative equity, you can sell the car before you get too far behind on your payment. If you do have negative equity, you may have an option to get a personal loan for the difference between how much the dealership or the buyer is willing to give you for your vehicle and how much you still owe. This will shorten the recovery time for the loss of income and damage to credit. If you're a first-time home buyer or you haven't owned a home within a certain amount of time, your rental history becomes a factor. Evictions can demolish the opportunity to get a mortgage loan if they occurred within the last 3 years. Without an acceptable reason for the underwriter, a default for your living arrangements is a hard stop. Step 2. Dispute any errors. If something's inaccurate, dispute it right away. It usually takes 30 to 45 days to resolve. It can make a world of difference on your credit report if you are a true victim of fraudulent activity. Step 3, pay down your debts. You're going to start with collections. Negotiate for pay for delete agreements when possible. Always get the terms in writing prior to making the payment. Making payments to clear up the collection doesn't help you as much as making a payment to have it removed. A quick tip here, consult with a credit repair person to help get you on the right path to a bad credit mark removal. I would not recommend using secondary sites like Credit Karma to dispute items from your reporting bureaus. Step 4, build new positive credit. Use a secured credit card or credit builder loan. And there are also more recent options available like Self to get bill payments reported to your credit that can give you a quick 20 to 30 point boost. You may also have the option to become an authorized user on a trusted person's account. But be careful here. Be sure it's someone you know will consistently make on-time payments. You don't want to have this go in the opposite direction of your goals. Pay on time, every time, and keep your balances low. Step 5, be patient and consistent. Rebuilding takes time, anywhere from 6 months to even a few years, depending on how severe the damage was. But steady progress always pays off. Becoming mortgage ready is about knowledge and discipline and consistency. By understanding what lenders are looking for, working to strengthen your credit, protecting it through life's challenges, and recovering strategically when setbacks happen, you'll position yourself for homeownership success. If you'd like to talk about your specific situation or start your mortgage journey, my contact information is in the description below. Don't forget to like and subscribe, tap the notification bell, and share it with your friends and family so that we all are on a better path to managing our credit and financial success. Thanks for watching, and I'll see you in the next video.